Back with us here on Chartbusters and on to another corporate conversation then is turning our attention to logistics solutions provider Transport Corporation of India. The company's managing director Vineet Agarwal joins in to discuss the future business outlook and a peek into demand expectations from the upcoming union budget as well. Vineet, good morning. Thanks a lot for joining in. Now, I want to ask you firstly about your outlook for FY25 because in FY24 you grew at around 6.4%, which was slightly lower than your range of around 8 to 10%. Do you see that reverting back to those levels in FY25? What's your view there?
Always good to be here when we are not talking about earnings. Last year was expected to be a little slow because of the impending elections and just the global market will also slow down, which had some impact on India. And of course, consumer sentiments in India were slightly weaker as well. Our trajectory of about 10 to 15% on the top line should continue this year. As well as 10 to 15% on the bottom line as well. So yes, the margin was slightly compressed last year, but overall we still did reasonably well, and the businesses all grew, and we had a very strong position to take this forward.
All right, 10 to 15% growth on both the top line and the bottom line would imply margins around that 10 to 11%, which would sustain. Let's talk about the Seaways division, though. I mean, there has been a lot of international uncertainty. People are talking about geopolitics, etc. What routes do you operate, and was there any impact of crisis on your performance? How have freight rates panned out in the Seaways business?
Our Seaways business operates domestically. We operate on the west coast with ships operating from Kandla to Cochin, and on the east coast from Vizag, Chennai to Port Blair. So the international rates don't really directly affect us, but indirectly they do. We know that the crisis that happened is happening right now in the Middle East. The Panama Canal recently had a crisis where they were actually struggling to have enough water for the ships to pass through, which is now resolved. But all of these have led to an increase in prices globally for ships as well, not just container rates. And that has an impact when we are trying to acquire ships. Clearly, the impact is also there indirectly on fuel because fuel is a direct correlation of what is happening in the Middle East, for example. And that has an impact on India as well, where the bunker prices have gone up, though the fuel prices on our pumps have not gone up. But on the bunker level, the prices have gone up as well. So there has been a slight increase in freight rates on the domestic sector, but not really that impactful. However, the acquisition of ships has been very difficult. We've been looking to buy ships for a long time now, and we've just not found the right ship or the right quality. We've also looked at buying new ships and giving orders, and we're in the process of discussing and trying to finalize some of that.
What could be the reason behind that, Vineet? The struggle behind the lack of ships for acquisitions? You've been placing new orders as well, but when do you expect that to fructify?
Actually, the new order that we had placed had got cancelled by the shipyard, actually, because they had some issues with their banks. However, we're in the process of looking at new orders, which should start happening and should deliver, if everything goes through, by the middle of 26. However, the second-hand ships, which is typically what we tend to buy, those are not available because they have been plying on several trade sectors, which are short trade sectors. We don't buy the very large ships. We buy little mid-size container vessels. So it's the international crisis that has really driven these prices up quite substantially.
So 26 to 27% margin in the shipping business likely this year?
That's right. I think that should continue. The business is stable. The capacity is, we don't have extra capacity, but the rates are also stable. So I think this margin structure should continue.
All right. I just wanted your thoughts on two verticals which you recently entered into, the potential, the rate at which they're growing, and the targets that you have for the next couple of years for this one. You did almost 90 crores in the cold chain business in FY24. That is a fast-growing business. What are your targets for this business over the next 2 to 3 years? And also chemical logistics. You entered that business last quarter as well. So what are your targets here in terms of revenue contribution?
The cold chain business is very exciting. I think in the next few years, we are going to see a dramatic shift of consumer trends towards more and more processed foods, as well as the fact that there is QSRs that are growing. Chemicals are themselves require certain kind of cold chain, as well as even semiconductors might require cold chain in the future. So the potential is massive, and we are looking to grow at about 20-25% CAGR for the next 2 to 3 years. We made a substantial investment last year by investing 75 new trucks in this space. We're adding cold storage capacity as well. And this augurs very well for the business in terms of the next 5-10 years. It's a high growth business. The second is chemical logistics. Again, chemicals in India has been very much fragmented in terms of the logistics. There have been more unorganized players that have been there. With the China Plus One strategy, we are seeing chemical companies also adding capacity in India, as well as Indian chemical companies growing and wanting world-class transportation and logistics best practices. We are providing those now. And we've been doing for some years, but now we've structured this into a more definitive entity to grow this business forward. And it is, again, an extremely exciting space as well.
Very quickly, Vineet, due to paucity of time, 10 to 11% margins is a reasonable target to achieve for FY25?
Yes, it is. That's the short answer. However, being here, I would definitely like to take the opportunity to tell you that the budget needs to have a lot more focus on infrastructure. The need for infrastructure for logistics is imperative. That's the only way we can actually reduce the logistics cost by moving towards more multimodal logistics, and hence infrastructure is very important.
All right. Thanks a lot for joining in, and we would have liked to speak with you a lot more, but due to paucity of time, we'll leave this conversation right now with the promise of more after the budget is announced. Hopefully some softs coming in your way for the logistics sector as well.